Craig, thanks for joining us today.
Thanks for having me, Rob.
No problems. Look, I thought it was timely that we had a discussion given all the volatility that we're seeing in markets recently, and you could give us an update on how Gyrostat's performed.
So, particularly well, as we're really designed for volatility. So our Class A units, which are the lowest risk, are up 3.3% up for the last 3 months and running at over 11% per annum for the last 3 years, with the worst drawdown in that period, negative 1.2%. So it's really performing very well. And importantly, each time the market has gone down, it has gone up significantly, as consistent with our track record of the 14 years now of never breaching the 3%. We've also got our Class B, Rob, by the way, which is a levered version, which is up about 5% over that period, 3 months, and up nearly 15% per annum. So that's specifically designed for the more volatile up and down. And its worst drawdown in the 3 years is minus 0.8%. So that's by far our top performing, but they're both doing particularly well with the absolute return. And we've got 3 products versus the index, an Australian, a Hong Kong, and a global, all way ahead of the index, between, let's look at my numbers, between 2.5% and 5% over the last 3 months. And our best being over 25% over the last 12 months, Hong Kong, and consistently for the 3 years, 15.5% ahead of the index. So everything is designed with our strategy of protection always in place and getting those excess returns above your benchmarks in volatile conditions.
Okay, so just on that, how are you able to achieve such a contrasting return against the market? Like, what is the basic overall strategy and on how you generate the returns and manage the risk?
The overall strategy is we have a 2-dimensional payoff. So it's shares, but there is always protection there. So you can imagine a hockey stick, and as the market moves up and down, we're able to generate profits with each of those moves and then close down the risks. So essentially, in more volatile markets, you get the chance to make profits as the market is moving around in either direction even more. So it's a fundamentally different prism than predicting. It's just the natural vibrations of the market.
So what are the actual assets that you own?
So within our absolute return, they are, as I call it, stocks always protected. So it's the ASX 20 stocks and the index. So in there, you've got those commodity stocks, the banking stocks, and the index itself. And an investment of, say, $1 million, 950,000 will be in the underlying stocks. And we just hang on to that underlying stock. What our skill is, and the big breakthrough is being able to have protection always in place. So we scan all of the time periods out to 12 months and find where the lowest protection is. And as people's perceptions of risk are all over the place with the news flow that you're seeing, you tend to find these windows where you can inexpensively protect. So as we're recording now, in August, September, I'm finding some of the lowest protection costs I've seen for a number of years, which is counterintuitive to what you would see in the press. So as a result of that, we're able to meet our product objectives and yet have inexpensive protection in place. And then as the market conditions change and people's perceptions about risk change, we're able to move that around, such that about 95% of the capital is in the stocks and 5% is in the protection.
So when you say protection, you're buying a put.
Yes, it's buying a put. So in crude terms, let's say we bought BHP for $40. We'd have the right to sell it for no less than $39. So that's always there for the quarter. That's how we've never, ever breached our parameter. And then in the event that the stock, let's say it shoots up to 42, we'll move that lever up We'll run the system and say, where's the lowest cost protection now? And we'll restore those balances, banking our profits. And then if it goes down, we have as a permanent feature more protection than underlying stock. So if we own 10,000 stock, we may well own 11,000 puts, or there's this extra that floats there. And that's why you see that protection always reliably goes up. And as a result, on each of those drawdowns, we just consistently go up. And the beauty of that is we've got a beta of minus 0.2 over the 3 years. So with a relatively modest allocation, you can dramatically reduce the risk of your clients' portfolios. And with all of these different perceptions of risks, our returns are in excess of the index in any case. So you're actually covering a broad range of scenarios, as well as being able to de-risk the portfolio. And that happens in these more volatile market conditions as pricing of risk is all over the place and asset prices moving around in either direction.
So on that pricing of risk, so given that everything's going on, we've got, obviously the US debt and the fiscal position that they're in. We've got inflation, we've got corporate earnings, we've got tariffs, we've got geopolitics, we've got Trump, just Trump.
Got a nice buffet there, haven't we?
Yeah. So talk to us about risk and how it's priced and how you're looking to take advantage of that.
So market participants are taking a view whether they're buying call options that the market will go up or buying protection to cover their books if the market goes down. So you see that in the press, all of these narratives. What I see is a price based on a Black-Scholes models. What is the standard deviation, or the VIX would be the crude one that's being priced. So what you've seen is in the last month or so, the VIX has gone from 60 to 18. What that means, crudely, is if the stock price is 100, a 60 means it's pricing at one standard deviation of a 60% price move up or down. And that has narrowed dramatically now down to 18%. So there's this lull. So the news flow of recent times has been such that there's been a risk off. But we see through history that changes often within 2 or 3 days and it explodes. So at Gyrostat, we don't, there's actually more going on in our risk management framework. The core of it is to always have at least the same number of put options or protection as underlying stock and a bit more so it reliably goes up. But we're dramatically changing that duration depending upon where the sweet spot is. So what I mean by that is back in April when it was at 60, we had our protection, some of it was even in May or June because it was so expensive. But in that sense, we were able to sell call options and receive incredibly large premiums because the prices were up. Some cases, the vols were 120. And in the market in Australia, we have durations every Thursday for the next 3 weeks and then each subsequent month. So essentially our skill is knowing how to blend that risk management overlay to respond to whatever the conditions are, as distinct from predicting. So it gives you a very, very powerful platform to go from, to not just say we buy puts 10% out of the money, or we just blindly sell call options, or we do this like some other strategies. We are saying, no, we will meet your 3 criteria. We'll be low risk. We won't go down more than 3. We'll go up if the market goes down, and we'll go up. The more it goes down, the more we'll go up. And whatever happens in the phase of the market will generate these returns like we're doing, which will increase with volatility. So I've come at it from my industry background, more from a Porter competitive strategy. This is the product people want, not this prism of we can predict. This is the product that people want, and you can add it to your portfolio so you can cover a broader range of scenarios.
Yep, no, that's great. I in talking to people, investors, clients, advisors, people are still stuck on this buy the dip narrative. She'll be right. Everything goes up. I think it's not going to end well, but anyway, time will tell.
Well, I'm with you on that. And that's the whole point, isn't it? About the accumulation to retirement mindset. If you're in
Correct.
accumulation and you've got an income and it does go down, you can dollar cost average. And I've seen many that talk about that, and that's fine. But in the event that you are retired, you don't have the income to take advantage of that. Your sequencing risk is particularly significant, and the emotional risk that you suffer when you see your lifestyle being drained can be dramatic. So as you move those smile risks, that S and that E become so much more prevalent. So I would say people saying that are in an accumulation phase mindset, yet the segment of the client we're looking to help is the retirement phase client mindset, and that doesn't cut it. That mindset just doesn't cut it.
Yeah. So going back to the smile threats, you sort of talking about that in your last investor update. Can you talk more about that?
Yes, we're very fortunate that we're now published globally out of London. We write some thought features each month, so they'll be available for your viewers if you go to our site. And it's all about, since 2010 in Australia, essentially it's been saying, how can we move from this accumulation phase mindset to this retirement phase mindset? How do we do it? And in particular, these are the smile risks that asset in portfolio construction we need to address, and which ones become important in which phase of the market. And it's clearly the sequencing risk matters a lot more in retirement than accumulation. And the emotional impacts matter much more. We've got Kahneman, we've got so much loss aversion in the psychology. So the industry went a step further, which as a product designer to me was particularly helpful. The industry came in and said, we need products to put in our portfolio that do these three things that address smile risk. We need to be lower risk, however you do it. It has to be in a growth asset, but so you get longevity. Can't just be a bond. It can't be any of those. It's got to be able to get me growth, but some sort of risk management, whatever it is, go crazy. The second one, if you can get us non-correlated returns, the more the better. And I thought, well, the best way to do that is the way we do it, dynamic hedging, and just always have extra protection. So that's the second. And the third was just pay us a regular income. We can live off it, and it's robust. So even if the dividends go to zero, you can pay us our regular income. Now, in our case, we had the bank's dividends go to zero, that the stocks went down, the extra protection went up. So we've got a couple of barrels, we could pay it out. So we pay the quarterly income, all cash, through September, December, and March. And then there are some franking credits that accumulated that we pay in the June distribution, so the investors can get their tax return and use them quickly. So that's what we've tried to do. The other really significant thing in those reviews said the three holy grails are, can it be liquid as well? Sure, you can go into private credit, you can go into all sorts of things, but if you want your money quickly, you can't do it. Ours is all listed on the exchange, transparent pricing. You can get your money next day. So you get liquidity, you get the income and the defensive characteristics all within the one product. So I found those reviews particularly helpful because all the industry and advisors participated saying what they wanted. And I've seen not only us, but around the world, I'm getting now exposed to many others that are developing products such as this, which is really helping groups go from the accumulation to the retirement phase. In essence, the Shartru way, what you're trying to do. That's essentially the overlap. That's exactly what you're doing.
So Craig, sorry to jump in, but just it's I'll refer to it later. We're going to send out an information flyer that'll have it in, but can you just qualify what the smile threats stand for?
Oh, yeah, sure. So the smile threats are the sequencing risk, the market risk, the inflation risk, the longevity risk that you're not going to generate returns, and the emotional risk from the roller coaster of stock markets.
Yep. That's pretty much it, actually. That's well done, whoever came up with it. So talking about, you're doing a great job, but you've also got some good recognition recently. You've won some awards in London and Hong Kong. So tell us a bit about that.
Yes, we were particularly pleased that we were awarded the most innovative wealth manager in Australia 2025. So Global Financial Market Review are particularly focused on how their readers can go from the accumulation to the retirement phase. And managers around the world that are meeting these various industry review criteria. So for me, it's great recognition for us that, in fact, we have met those criteria that the Australian government and the industry have looked for. And it's also put me into contact with some colleagues in other spots of the world. And we're sharing ideas with each other so we can all continue to improve our products in our respective markets and how we can take advantage of these various volatility skews or pricing of risk. So we see it a very collaborative way to do things. And that was the reason I've been particularly pleased to get our thought process challenged by Wall Street and challenged by the City of London and those things. So we've now got a regular column, and I get some feedback on those from what may be product features that can further improve the experience for our investors. So I'm particularly pleased with that. Not only for the team, we've been going for 14 years. It's been a very long slog. And to get that recognition, I think, is particularly important. The Hong Kong award was from the World Business Awards, and that was the best alternative manager in Australia. And that was particularly focusing on those alpha excess returns and broadened it to those, what we have as class C, D, and E is the outperformance versus index. So we've got this, our first trend is accumulation to retirement. Our second trend is many are in these passive low-cost ETFs, but they're going to go down by definition with the market. So I had an idea, what if we put 98% in the underlying ETF, just buy it, and put 2% only in the protection? So we've been seeding these for 3 years now, and to outperform the index by many stages, 25, 30% is unheard of through the literature. So they awarded that and coming out of Asia. So we've got a number of initiatives going on about helping us to commercialize that in those markets. So again, it's that recognition that gets us in front of potential partners to commercialize to what we'd like to think is very large scale.
Yep, good work. It's I've been a big fan of what you guys do and why you do it. I think you've articulated the why you do it. It's very personal to you, and this is the conversation that good advisors should be having with their clients to make sure that they're sort of avoiding as much as they can that sort of situation. So great work.
Thank you.
Now,
We've actually, can I add there, Rob, there's a number of key, I call them key alliance partners that we've been working with. And they, in fact, had a script that they've been using with their clients. And we've published it on the homepage of our website. And we call it financial peace of mind, irrespective of stock market outcomes. Very powerful.
yep.
And it literally explains the products. It has the process that you can go through with the client and explain why you're recommending moving a beta 1 to us. The other thing that we've done is we have a relatively simple little Excel spreadsheet that shows what they've been in with the beta 1. And it's got our class A and class B, and you can adjust the percentages. And it doesn't take much, and it shows you what happens to the return, what happens to the income, and what happens in particular to the beta, and it drops dramatically. So we've done everything we can from the feedback of the key advisors that we're working with to make the role of the advisor much, much easier. And since I've last had the chance to present to your group, with Michael's help, I'd like to think that's a really, really big initiative that we've done. So it really can enable the advisor to explain it very simply.
No, that sounds like a great tool.
And the other thing we've done is there's a feature article at our website that goes in for about, I think it's about 800 to 1,000 words, that all we've spoken about today, the advisor is using that with the client out of London and globally, saying, this is what Gyrostat does, and the tech and the pricing of risk and all those things. So we've got a couple of things there which Michael has to really do everything we possibly can to help your advisors have the comfort to do what we think is in the client's interest.
Yeah, no, good. So Michael, is there any update that you have for the advisors from the distribution side of things?
Yeah, look, very quickly. Craig's just stolen a little bit of my thunder. So on Monday, I'll be sending out an email to the group that will attach the document that Craig's just referred to. It's really about making that conversation with the client that little bit easier. References why they would be making a recommendation about adding Gyrostat to the portfolio, what that will provide as far as outcomes, and obviously dealing with the smile threats. And I'll also attach the portfolio construction tool. Look, it's very simple. It's effectively just an Excel spreadsheet which will allow you to play around with some scenarios around allocations between, in effect, the market and Gyrostat, and see what the outcomes would have been historically in given markets, or you can play around with what potentially it would look like in certain market scenarios. So it's just a simple tool to help map around, again, what kind of allocations you're looking to make, but also in that explanation to clients why you're making that particular sort of allocation. So we'll get that out early next week. Update on platforms. So for a lot of the advisors in the network, they've been waiting for us to progress the super pension access abilities on the platforms. So we've commenced that this week, starting with Hub. We'll work through the other platforms, being NetWealth, Masons, PowerWrap, Macquarie, as quickly as we can. Generally speaking, Hub are generally pretty quick to get things done. So we've commenced there, and I'll provide updates on availability. But the plan is obviously to make that accessible as early as possible. I guess the next point there is that that the Shartru team has made access available for some time through the MDA. Access can be had at any time now through the MDA, special situations, whatever it may be, allowing them to make an allocation directly into Gyrostat. And then really just the last point, and it's just a feature of the product, is that the June quarter distribution includes the 12-month franking credit. So anyone that invests between now and June 30 will get access to the entirety of the 12 months franking for their clients. So just a little added incentive to get invested before the end of the financial year.
Yeah, okay, so that's good. So just, you mentioned the MDA there. So Gyrostat's included in the income version of the equity sleeve. But how some guys are also using it in the MDA is they might have a more growth focus in the MDA, and then they add Gyrostat in the special or the tailored.
Tailored.
The tailored portfolio. Yeah. So so they're getting that match that way, which is perfectly fine. So okay, very good. Well, gentlemen, thank you very much for organising the time. Craig, congratulations to you and the team, delivering exactly what you say you're going to deliver. Well done.
Thank you very much, Rob, and thanks so much for the chance.